Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to asset mix and financing mix. Get ready, it's time to take your chance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area on the right-hand side. We're going to be considering our financing needs, breaking out the financing needs between short-term and long-term financing to try to maximize the interest rate or the expense on the financing. The short-term financing typically having a lower rate than we may need if we want that longer-term financing. The longer-term financing being less risky, less aggressive. As we do this, remember the accounting equation: assets equal liabilities plus equity. Whatever assets we have are going to have to then be financed either with liabilities or equity. We're going to be focusing in on financing the assets that we have with liabilities. Now remember, the assets that we have, why do we have the assets? In order to generate revenue. The assets are the things that we're going to get a return on to generate the income. So we need to finance those assets so that we can have the ability to generate income either with liabilities or equity. We're going to be focusing in on the liabilities to finance the assets. As we do so, we will break out the assets into a categorization you may not be familiar with yet, but it can be a useful way to consider the assets in order to consider the types of loans that might be appropriate. We're going to say that we have the temporary current assets, permanent current assets, and then the fixed assets. Fixed assets we've seen before: property, plant, and equipment. Long-term things, depreciable assets. These two are kind of different here because we're basically breaking out the current assets. Now, when you think about current assets, you're probably saying, hey, look, those are current, those are temporary by nature because we're going to be using them. If you think about accounts receivable or like inventory, the point is that we're going to be receiving the receivables. They're only going to be temporary in nature. How can we have a permanent current asset? That's the one that usually kind of doesn't ring right in the mind there. But it's not that any one account in accounts receivable or say inventory are going to be permanent, because they're going to constantly be rolling over. It's the fact that they're going to be permanently replaced, and therefore we can think about them as having kind of a baseline level. So in other words, under normal production circumstances, we're going to have receivables that will continually be replaced even as we can collect on them with new sales. We're going to have inventory that will continually be replaced with new purchases even as we sell the inventory. So we can kind of have a baseline on these current assets. Even though they're temporary in nature, they're current. We can kind of have a baseline of what's going to always be there given normal conditions, and then say of those assets, those are the things that are going to need more permanent financing because they're always going to be there. And then we might have some other assets that are temporary in nature, meaning, for example, we might have a spike in sales for a particular point in time, which could increase to a spike in the necessary inventory and a spike in the necessary accounts receivable, for example. And those might be items that we don't expect to be on the balance sheet for a long period of time. We expect them to go down later, and therefore they're not something that needs permanent financing, possibly, but possibly something that we can then categorize as temporary financing. And this could be an attempt to us to then break out our financing needs, our financing mix, the loans we need between permanent and non-permanent needs, and therefore take out a loan, possibly a longer-term loan for those needs that we think are going to be more permanent. And that's going to be the more conservative kind of approach, typically with a larger interest rate, but with a rate that it's going to be fixed over a time period, versus the short term where we might take a loan out for a shorter period of time, typically getting a lower rate if we were to do so, and or picking up a loan that might have a flexible rate that could change over time, and that brings more risk, but that it is lower at least in the first year and that we're picking it up. Okay, so that's going to be our idea. So we got the temporary assets, permanent assets, fixed assets. We have the short-term loan rate, the long-term loan rate, the earnings before interest and taxes, the tax rate at 35%. If both the long-term financing and short-term financings are perfectly matched with long and short-term asset needs, what is earnings after taxes? All right, to calculate this, let's take a look at our long-term financing needs. What do we need in terms of the long-term financing? Well, we're going to be picking up, obviously, the fixed assets, but we also want these permanent current assets, which we're going to have to break out. We're going to have to look at our balance sheet. They're not always, they won't be broken out on the balance sheet. Those are only going to be current assets. So we'll have to look at those current assets and break them out to what we consider to be permanent and temporary. We're going to say the permanent current assets are the 1,500. We got then the fixed assets. Obviously, the property, plant, and equipment is not going to be going anywhere, and therefore is basically permanent. So we're going to be picking up the 1,600 there as well. Home tab, font group, underline. Then we're going to have the total, and this is going to be equal to the sum of the 1,005 and the 1,006. Then the short-term financing needs just represent the current assets that are temporary, that temporary spike in current assets, the receivables that we expect to be going back down, or the inventory that we expect to be going back down once we get back to normal time. So these are things that we don't expect to be at constant levels. Then we're going to say that we have the interest expense. So on the long-term interest expense, we're going to take the long-term financing needs and multiply them times the long-term rate at the 15%. This equals the 3,100 times the 15%. Then we have the short-term interest expense. And this is going to be our short-term financing needs, so equals the short-term financing needs times the short-term rate, which is going to be less. We're going to be a bit more aggressive on that one. Home tab, font group, and underline. This is going to give us our total interest expense. And then we'll sum that up with our trusty sum functions, equal the sum of the 465 and the 200. So then we're going to put together our income statement from the earnings before interest and taxes, basically income, net income before we consider interest and the tax expense, because that's what's given here. So we're going to say the earnings before interest and, oh, that's not interest and taxes. So this whole thing is messed up. Hold on. Earnings before interest and taxes. Okay, maybe I'll edit that out there, but it's going to be the 1,050, and then we have the interest expense, which is going to be what we just calculated up top at the 665. If we put an underline there, it's going to be home tab, font group, and underline. And then we're going to have the earnings before taxes, which is going to be equal to the 1,050 minus the 665. Then we calculate the taxes on that, which is going to be the earnings before taxes, the 385 times the tax rate, which is 0.35 or 35%. Let's put an underline there by going to the home tab, font group, and underline. And then we finally have the earnings after taxes, which is equal to the 385 minus the 135, giving us the 250. So bottom line point here is that we can start to consider, how we're going to be financing, the assets here, and how we can think about possibly a mix between a more aggressive short-term financing plan, which could come with more risk, of course, and then a more conservative or non-aggressive plan with relation to possibly those longer term assets that we're going to need to finance over a longer period of time and help us to make that decision.